Welcome to the Deep Dive. We're here to cut through the noise, look closely at the key sources, and give you the insights you need to, well, really understand what's going on. Think of it as your shortcut to getting informed, with all the crucial details and maybe a few surprises along the way. Okay, let's unpack this one. Today, we're diving deep into a deal that wasn't just news, it sent shockwaves to the markets. We're talking about the huge agreement between Nebius Group, that's NBIS on NASDAQ, and the giant Microsoft, ticker MSFT, and the market. Whoa, the reaction was instant and pretty dramatic. Nebius stock just soared nearly 50% right after the announcement. And if you look back since the start of 2025, the total return is like over 240%. That's not just a jump, it's like a rocket launch. So our mission today is pretty straightforward. We're going to explore this Nebius Microsoft deal from every angle. We'll break down the massive upsides that have obviously fueled this rally, but also dig into the risks, the ones maybe hiding beneath the surface that are now tied to Nebius stock. And to do that, we've gathered insights from a bunch of different analyses on Seeking Alpha.
You'll hear from the bulls, the more cautious voices, even some bears. We want you to get the full picture, all the nuances, everything you need to really get a handle on this situation.
What's fascinating here, I think, and really the key starting point, is understanding Nebius itself. They're essentially a data center platform, right? But with a very specific focus, GPU as a service. And that puts them right in the middle of probably the hottest market there is right now, AI infrastructure. So the big question we need to explore for you, the listener, is this. Is this deal the massive game changer everyone says it is? You know, the thing that completely rewrites Nebius's future? Or has the market just gotten way too excited? Has all this potential already been baked into the stock price, leaving some pretty significant risks just unaddressed?
Yeah, and it's so important to understand the bigger forces driving this. I mean, we are seeing absolutely surging, almost like insatiable demand for high-power GPU computing. And this is coming from the hyperscalers, you know, Microsoft, Google, Amazon, that companies building the massive cloud infrastructure that powers so much of our digital world. They need these GPUs for AI. And it's not just a temporary thing. This demand is fueling just explosive growth in the GPU as a service market itself.
Precedence Research, for instance, they're projecting this market will grow like 6.4 times over the next 10 years. Think about that. That's a compound annual growth rate of 23%. It's not just a tech trend. It's a fundamental shift in how computing power, especially for AI, gets delivered and used globally. It's a whole industry transforming right before our eyes.
It really is a huge shift, and Nebius just landed right in the thick of it. So let's get into the specifics, the nuts and bolts of what actually went down. This is where it gets really interesting, and you see the sheer size of this thing. So the core deal they announced, it's a $17.4 billion contract spread over 5 years. That's Nebius committing to provide these crucial GPU infrastructure services directly to Microsoft for half a decade. It's massive. And if $17.4 billion wasn't enough, Microsoft also has an option to increase that. If they decide they need even more capacity later on, the total value could actually climb up to, get this, $19.4 billion. That tells you something about Microsoft's own expectations, right?
Absolutely. It signals huge anticipated demand on their end.
Now, rolling this out isn't instant. That's important when we talk about risks later. It's a phased rollout planned in several stages or tranches throughout 2025 and into 2026. And geographically, the main place this is happening is Nebius's big new data center coming up in Vineland, New Jersey. They're saying the first 50 megawatts there should be ready around December 2025. After that initial bit, another 300 megawatts will be commissioned over the next 6 to 9 months. So the whole facility should be fully built out by the end of 2026. We're talking about a very fast but phased deployment of just immense computing power for Microsoft's AI needs.
And Vineland makes sense, right? Good power grid access, fiber optics, all crucial for this kind of operation.
Yeah, and if we connect this to the bigger picture, I mean, you just can't overstate how huge this is for Nebius. Just think about this. That initial $17.4 billion deal value, it was actually more than Nebius's entire market cap before the announcement. Their market cap was somewhere around, what, $15 to $16 billion? Maybe $16.4 billion according to one source. So getting a contract worth more than your entire company valuation, that's not just a deal, it's completely transformative. It's a defining moment.
It really puts it in perspective.
And look at the annual revenue this could bring in. It averages out to about $3.5 billion a year.
Yeah.
If Microsoft takes all the options, it's closer to $3.9 billion a year. Now, compare that to what Nebius was expecting before this deal. Their annual recurring revenue, or ARR, was projected to be maybe $900 million to $1.1 billion by the end of the year.
So this is like triple or quadruple that. Exactly. It's a multifold jump almost overnight in their revenue visibility. It gives them an incredibly clear path for growth for years. It's not just growth, it's like hitting hyperdrive.
Okay, but what about Microsoft? Why Nebius? What's their angle here?
That's a great question, and it tells us a lot about the industry. Analysts are suggesting this is really a smart diversification move by Microsoft. You know, hyperscalers like them have sometimes relied very heavily on just one or maybe a couple of key partners, and that can create risks. Remember that CrowdStrike system update issue back in 2024? Things like that show how fragile it can be if you depend too much on a few providers. So Microsoft probably doesn't want to, put all its AI infrastructure eggs in one basket.
Makes sense. Spread the risk.
Precisely. By bringing Nebius in, they're broadening their base of suppliers for this critical AI infrastructure. It helps ensure they have the capacity they need, builds redundancy, and honestly keeps everyone competitive. And look, this deal also fits into a much wider trend. The absolutely massive spending, the CapEx, that hyperscalers are pouring into AI and cloud. This isn't just Microsoft taking a flyer on Nebius, it's part of a necessary expansion. Microsoft themselves are set to spend, $30 billion just in the current quarter on this stuff? Alphabet bumped its CapEx projection to $85 billion. These numbers are staggering. They show this AI spending boom is real and accelerating fast.
So it validates the whole sector, in a way.
It does. And specifically for Nebius getting this nod from Microsoft, it's a huge signal to the rest of the industry, to other huge tech companies. It basically says Nebius is legit. They're a credible, institutionally backed solution for AI infrastructure. It moves them way beyond being seen as just some unprofitable startup with a risky business model. It's a massive stamp of approval. Really opens doors, you'd think.
That validation point is huge, isn't it? And it leads us right into the bullish arguments. So for the investors who are really excited, what does this all mean? Why the optimism? Well, for a lot of analysts, this deal is basically the ultimate proof that their bullish view was right all along. People like Dhiren Pichai and the team at Oakhoff Investments, they've come out and said this confirms Nebius can scale up quickly and tap into that massive hyperscaler growth. It's the I told you so moment for them.
Right. The validation they were waiting for.
Exactly. And Oliver Rodzianko made a great point about perception. He said Nebius has gone from being seen as a speculative GPU cloud player, kind of risky, right, to an institutionally backed AI infrastructure provider. Just think about the difference in those terms. It's a huge leap in credibility in how the market sees them. It's not just about the dollars, it's about reputation, stability, their place in the market.
That's a key shift. Perception matters a lot in these markets.
Totally. And this Microsoft partnership, it's not just about Microsoft's money. It's seen as this massive vote of confidence. The thinking is this will likely attract other customers too, maybe smaller ones, maybe even other big tech players. It could set off a chain reaction leading to more contracts down the line. It's like a halo effect.
Okay, so this raises an important question then. What are the tangible financial and strategic pluses Nebius gets from this, beyond just the validation? Well, first and foremost, it's obviously the huge locked-in revenue boost and that clear long-term potential we talked about. The Nebius CEO, Arkady Veloz, he's even been quoted saying they expect to sign more significant long-term committed contracts with top AI labs and other big tech firms. He apparently said he believes there are more to come.
So they see this as just the beginning.
That seems to be the message. It suggests a growth path that stretches out for years, well beyond just this one Microsoft deal. And look at their recent performance even before this fully kicks in. James Ford pointed out their Q2 2025 revenue was already $105.1 million. That's up a staggering 625% from the year before. Management was already guiding towards $1 billion in revenue for 2025 before this deal. Now, Ford is looking way ahead and projecting maybe $15 billion in revenue by 2030.
$15 billion, wow.
Yeah. His logic is, given how fast AI infrastructure is growing and now this huge Microsoft contract, maybe those earlier analyst predictions were actually too low, too conservative. And another point with Microsoft basically booking a huge chunk of Nebius' capacity, Nebius might actually get some pricing power for the rest of its services.
Ah, supply and demand.
Exactly. Less available capacity could mean they can charge a premium for what's left. It's not just about volume. It could boost their margins too.
Okay, and what about the profitability per unit? Any insights there?
Yeah, Denis Buvalov, a CFA, actually ran some numbers on the unit economics. He calculated an effective hourly rate of around $2.70 per B200 GPU. That's assuming they deploy all 2007 of those high-density GB200 NVL72 racks.
And those B200s are NVIDIA's latest and greatest, right? The really powerful ones for AI.
That's right. These racks are basically pre-built powerhouses for huge AI jobs. And Buvalov thinks that $2.70 an hour rate is very solid compared to what else is out there in the industry. So it suggests the contract itself has strong profitability built in.
Okay, that's revenue and unit economics. But building all this out costs a fortune. How are they financing this? That's often the tricky part for companies growing this fast.
That is absolutely critical, and the structure here seems quite smart. The deal itself helps secure the financing. It's expected to be funded partly by cash flow from the contract. Analysts think Microsoft might prepay somewhere between $2.6 billion and $4.4 billion up front.
Okay, a big down payment, basically.
Kind of. And then the rest comes from debt that's secured against the contract. And here's the clever bit. Because the debt is backed by a contract with Microsoft with their top-tier credit rating, it makes it much easier and cheaper for Nebius to borrow that money.
Ah, so Microsoft's creditworthiness helps Nebius borrow.
Exactly. It significantly reduces Nebius's need to sell more stock, which would dilute existing shareholders to fund these massive capital costs. The remaining amount needed, estimated at maybe $1.6 to $3.4 billion for the GPUs themselves, Buvalov thinks is manageable through this secured debt structure. It really de-risks the financing side of things quite a bit.
That does sound like a crucial advantage. And you mentioned the Vineland site.
Mm-hmm.
Are they expanding elsewhere too? Is this deal enabling broader growth?
Yes, definitely. While Vineland is the centerpiece for the Microsoft deal, eventually becoming this 300-megawatt beast, this contract absolutely helps underpin their wider global plans. They're already tripling the capacity at their site in Finland, aiming for 75 megawatts there. That alone could potentially bring in another $1 billion in annual revenue. They've also got a smaller 10-megawatt cluster up in Iceland, which is interesting because it's powered by green energy, very important these days.
Sustainability is a big factor now.
It is, and they're not stopping there. Reports say they're actively looking for new sites, greenfield sites, in both the US and Europe. So this Microsoft deal isn't just filling up the Vineland facility, it's really acting as a springboard for a much larger global expansion strategy. They're aiming to be a major international player.
That global ambition is clear. But something James Ford mentioned really caught my eye, this idea of hidden value in Nebius's other businesses. It sounds like they're not just a one-trick pony focused only on GPUs.
That's a really interesting angle and potentially quite significant. He argues Nebius isn't just this AI infrastructure company. They actually own or have big stakes in several other pretty fast-growing businesses that could be worth a lot on their own. It makes the whole investment case potentially more diversified than it looks at first glance.
Okay, like what? What are these other businesses?
Well, for instance, there's Toloka. That's their AI labeling business. Apparently, it's already doing around $50 million in revenue run rate for 2024, and it's growing at a healthy clip, like 20-25% per year.
AI labeling.
Right.
Like helping train AI models.
Exactly. Data annotation, that kind of thing. And if you compare Toloka to other companies in that space, like Scale AI, Ford estimates Toloka alone could be worth somewhere between $250 million and $500 million. That's not small change, and it often gets completely missed in the GPU discussion.
Interesting. What else?
Then there's Triple Ten, that's their EdTech division, focusing on coding boot camps. It's apparently got a solid $60 million bookings run rate. There's also Everyday, which is earlier stage, focusing on autonomous vehicles and robotics. It's doing maybe $10-20 million in revenue, but is already partnering with Uber.
Okay, so real businesses in growing sectors.
Right. And maybe the biggest one is their stake in ClickHouse. That's a well-regarded database software company. Nebius owns about 28% of it, and ClickHouse itself is valued somewhere between $2 billion and $3 billion.
Wow, so Nebius's piece of that alone is worth
potentially $600 million to $900 million, just for that stake. So Ford argues that when you add up these side bets, they contribute at least $1.4 billion to Nebius's current value, maybe more. And they offer this long-term growth potential that's completely separate from the GP infrastructure story. It's like a hidden asset portfolio within the company.
That really does add another dimension to the story.
It does. And this whole picture, the massive deal, the diversified assets, it's clearly fueled some very strong positive sentiment from analysts, leading to some pretty aggressive price target increases. We're seeing multiple analysts sticking with their buy or strong buy ratings, arguing there's still significant upside even after that huge stock jump. Dhiren Bachai, for example, updated his models. He sees another 22-29% upside from here, setting a price target of around $115 for 2027. His reasoning focuses on that secured revenue and Nebius's proven ability to scale now.
Okay, nearly $115. What about others?
The Asian investor thinks Nebius is still undervalued even after the pop. They put a fair value market cap closer to $30 billion, which translates to about $125 per share. That's roughly 30% higher than where it was trading recently. They get there using a 15x price-to-sales multiple on projected 2026 revenues, reflecting how high-growth AI stocks are being valued.
$125, getting higher.
And then James Ford is even more bullish. He revised his target way up to $314 by 2030. That's based on hitting $15 billion in revenue, keeping a solid 25% EBITDA margin, and getting a 20x EBITDA multiple.
$314 is ambitious.
It is. And he even sketched out a scenario where it could go over $1,800 a share if it traded at a really high, like 30x price to sales multiple on that $15 billion revenue. He's basically saying Nebius could become the Palantir of data centers, a company using its unique infrastructure in very strategic, high-value ways. And even Oliver Rodzianko, while suggesting maybe taking some profits tactically, still expects strong, like 30% annual returns, simply because Nebius has now proven itself as an elite-level hyperscaler partner. So the bulls are clearly seeing this Microsoft deal as unlocking a truly massive growth path.
Those are some seriously compelling arguments. I mean, a future that bright sounds incredible for investors.
Yeah.
But we always have to look at the other side, right? Especially in a sector that needs so much money and where things move so fast, there have got to be counter arguments, real risks. So let's flip the coin. Let's focus on the cautious voices, maybe even the bears. What are the potential problems, the pitfalls they're warning about? Okay, let's unpack that side of the story.
Right. Because it's definitely not all sunshine and roses. A huge concern that comes up again and again is the sheer cost, the high capital expenditures, the capex, and worries about when or even if Nebius will become consistently profitable. Dhiren Bachai, even though he's bullish overall, is very clear about this. He points out that while the contract is great for revenue, it demands significant capex. He estimates Nebius needs to spend an extra $2.15 billion to $3.2 billion on top of what they were already planning to spend.
That's a mountain of extra cash they need to find.
It really is. Growth isn't free, especially building data centers at this scale. And there's a timing issue, too. What if Nebius has to spend all this money up front, really front-load the capex to get the facilities built, but the revenue for Microsoft only trickles in slowly over the 5 years?
Yeah, that could squeeze their cash flow badly in the short term, couldn't it?
Absolutely. It could really hurt the stock price near term, even if the long-term picture is good.
Mm-hmm.
Oliver Rodzianko highlighted some pretty stark numbers here. Nebius ended 2024 with a net loss of nearly $400 million. And they'd already spent over $800 million on capex that year. It got even more intense in the first half of 2025. They burned through $352 million just in operating cash, while investing another $1.05 billion in new infrastructure. And then you have things like depreciation. That was $124 million in just the first half of 2025, eating away at the $156 million in revenue they brought in. That really hits margins.
And aren't power costs going up too? That's got to hurt margins as well.
Definitely. The massive power demands of AI are pushing electricity costs up, and that puts constant pressure on profitability for companies like Nebius. So Rodzianko's conclusion is pretty sobering. He says the path to profitability is still extended, capital-intensive, leveraged in the short term. And crucially, he doesn't think they can fund all this just from their own cash flow anytime soon. They're going to keep needing external financing, which, as you know, always comes with its own risks and costs.
Okay, so massive costs and a long road to profit. What about the actual execution? Can they pull off building all this stuff on time? And what about the financing risks beyond just needing the money?
That's the other major cluster of concerns. Execution risk is huge here. That agreement with Microsoft, it's not a blank check. It apparently has specific clauses allowing Microsoft to back out or at least cancel parts of the deal if Nebius doesn't deliver the GPU services on schedule or fails to meet the capacity targets they promise.
Ah, so there are performance clauses. Microsoft can walk away if Nebius messes up.
Seems like it. As Oliver Rodzianko put it, this creates asymmetric downside if milestones slip. It puts incredible pressure on Nebius management to execute perfectly on these incredibly complex multi-billion-dollar projects. There's very little room for error. And JR Research brought up a really interesting point about financing. Right now, the market is hot for AI infrastructure, so getting loans secured by the Microsoft contract seems feasible. But what if the overall mood changes? What if the AI hype cools down a bit, or there's an economic downturn?
Could lenders get nervous?
Potentially. If lenders get spooked, it could become much harder or more expensive for Nebius to get the debt financing they need to finish their extension plans. So, yeah, the deal is a huge opportunity, but it also ramps up the pressure on management massively. They need to juggle construction, supply chains, financing. Everything has to go right.
Okay, execution and financing risks are clear. But what about the stock price itself? After jumping 50% overnight, are analysts worried it just got too expensive too fast? Is it all priced in already?
That's a huge debate right now. That massive immediate stock surge definitely raised eyebrows. Okoff Investments, for example, explicitly warned people against chasing the stock after its massive pre-market gain. They worried about a potential sharp drop as early investors decide to take profits and run.
The classic buy the rumors, sell the news fear.
Sort of, yeah. Or just the reality that such a quick, huge gain often leads to some selling pressure. And JR Research and the techie are pretty blunt about it. They argue the valuation has just gotten extreme. They think most, if not all, of the good news from the deal is already reflected in the price. The techie pointed out Nebius was trading at a forward price-to-sales ratio of over 27. That's compared to a sector median of just over 3. That's a premium of nearly 750%.
Wow, 750% premium. That's a lot.
It is. And JR Research noted a forward revenue multiple of over 14x. Both suggest the market very quickly baked in substantial upside. When you see multiples that high, it means investors are betting on a near-perfect future, with huge growth already assumed.
Leaving little room for error or disappointment.
Exactly. So several analysts are warning about profit-taking. For a stock like NBIS, which might not trade in huge volumes, that can cause significant volatility. Now, maybe that creates buying opportunities for very long-term investors if the price dips, but it's definitely a risk for anyone jumping in at these high levels. You could face a painful short-term correction.
Makes sense. Are there other risks, like competition or maybe geopolitical stuff, given their background?
Yes, those are definitely on the radar, too. Competition is heating up. Okoff Investments specifically mentioned the rivalry with CoreWeave intensifying. As the GPU as a service market gets hotter, more players are jumping in, which could eventually pressure pricing or make it harder to secure capacity. And JR Research highlighted a more fundamental threat. What if the hyperscalers just decide to build more of their own AI infrastructure? We see Meta making huge deals, like that $29 billion one, to build its own stuff. If more giants go that route, it could reduce the overall market for companies like Nebius.
The build versus buy decision for hyperscalers.
Right. Plus, Nebius is still incredibly dependent on getting enough GPUs from NVIDIA. James Ford mentioned this. Any disruption in NVIDIA's supply, whether it's production problems, geopolitical issues affecting chip manufacturing, or just NVIDIA changing who gets priority, could seriously hurt Nebius's ability to deliver. And yes, the geopolitical angle is there too. Being a Dutch company but having Russian roots, Nebius is potentially more exposed to shifts in global politics, sanctions, or regulations than some others. That's an ongoing background risk.
And finally, doesn't this huge Microsoft deal make them overly reliant on one customer?
That's another valid point Oliver Rodzianko raised: customer concentration. A $17.4 billion deal is amazing, but it likely means Microsoft will dominate Nebius's revenue for years. They already had high customer concentration before this. Relying so heavily on one client, even a giant like Microsoft, always introduces some vulnerability. What if Microsoft's strategy changes, or their needs shift dramatically? It puts a lot of eggs in that one basket.
Okay, so we've heard the bulls painting this picture of incredible growth and validation, and the bears highlighting the huge costs, the execution risks, the stretched valuation, and the competitive threats. It's a lot to weigh up. So how do we bring all this together? What's the bottom line when you're trying to reconcile these really different views? It feels like the core tension is pretty obvious, right? Most analysts seem to agree this is a game-changer deal for Nebius. It validates them, opens doors, massive potential. But there's this significant group warning, hang on, the market got way too excited, way too fast. They're saying investors might be ignoring how hard this will be to pull off, how much it will cost, and how much risk is still involved. It really feels like a classic high reward, but also a very high risk situation playing out.
Absolutely. And if we step back and connect it to the bigger picture one last time, it's crucial to remember the context. Regardless of the outcome for Nebius specifically, this deal shines a massive spotlight on that relentless demand for GPU power and the incredible amounts of money hyperscalers have to spend on AI infrastructure. The GPU as a service market isn't just growing, it's set for potentially decades of explosive expansion. And Nebius, with its focus on building these specialized, purpose-built AI data centers like in Vineland and Finland, with advanced cooling, energy efficiency, they are genuinely well-positioned strategically. They're offering big, fast, and power-savvy deployments, as one analyst put it, with a sustainability-forward approach, especially in Europe. That gives them real advantages over competitors who might just be trying to retrofit older, less suitable facilities. Their specialized design is a key strength in this specific market.
So their strategy seems sound for the current environment.
The strategy seems sound, yes. But ultimately, Nebius's future boils down to that balancing act. The revenue potential from Microsoft is fantastic, unprecedented for them, but realizing that potential depends entirely on flawless execution. They have to manage these huge construction projects, complex supply chains for the most advanced GPUs, and handle billions in spending and debt perfectly. There's no margin for error when the stakes are this high. And those sky-high valuation multiples we talked about, they reflect all the current excitement and assume massive future growth is already a done deal. So the key question for you as an investor becomes, can Nebius keep surprising positively? Can they land more big deals like this? Or has the market truly priced in every bit of good news already?
Leaving no room for upside if they just meet expectations.
Exactly. Which leads to different investor approaches. Maybe passive, long-term investors are happy to bet on the AI trend and trust management to navigate the challenges. They hold on for the ride. But more active traders might be watching closely, looking for chances to get in if the stock pulls back, which often happens after such huge run-ups due to profit-taking, especially in thinner traded stocks. So the story isn't just if AI is big, it's how Nebius manages its incredibly demanding, high-stakes role in making it happen. Turning plans into profits is the real test now.
Okay, that brings our deep dive today to a close.
Mm-hmm.
And here's where it gets really interesting for you to think about. This Microsoft deal. It's clearly transformative for Nebius. It's thrown them into the big leagues of AI infrastructure. We've seen the staggering revenue numbers, the validation from a tech giant, huge positives. But we've also dug into the enormous costs, the immense pressure to execute perfectly, and that nagging risk that maybe, just maybe, the stock price already reflects all this good news. It's a complicated story, like most big market events, needing a really careful look from all sides.
Yeah, and this raises that important final question for you, the investor, to mull over. It's not just about whether Nebius can technically build these data centers or manage the contracts. It goes deeper. It's about whether the market, which some describe as being in an extreme greed phase regarding anything AI, has perhaps become complacent. Has it fully factored in the sheer difficulty, the operational complexity, and the financial strain that comes with growing this fast, spending this much money? So is this the beginning of a long, sustained rally for Nebius built on solid ground, or is it actually a moment where cautious reflection is needed? A moment to ask what risks or what future potential is genuinely still unpriced into this stock, given the monumental challenges Nebius now faces?